this webinar today. As discussed, we're going to talk about two topics today. I would really like to open your eyes to whether you're pursuing the right business model when trading your capital. Further, let you know what the perils are for leveraging yourselves too much, which is going to put you at a disadvantage towards everyone else, at least with the big guys in the market. And last but not least, I'll give you a framework on how to pick your own leverage and make sure that you do not die of retail traders' death, which, as you can guess, is over leverage in 90% of the cases. If you have any questions, feel free to type them into the chat room. I would be very happy to either take them there or then, or maybe we can leave some room at the end for Q&A. Okay, so what do I mean when I talk about healthy leverage? Well, let me introduce you to someone that I'm pretty sure you know already. Introducing Warren Buffett. This is the most successful investor of all times, third richest man in the world. And his rule number one is never lose money. Rule number two is never forget rule number one. The very important question about Warren, as you know, he's not a trader, but he's going to help us explain a principle which is very, very, very powerful. That principle is the magic of compounding, and I have put together an Excel spreadsheet which will help you internalize a few things which most people don't really think about when they start trying to produce returns in the market. So let's go for it. If you're curious about Warren's lifestyle and how he's grown into being one of the richest guys, you can check this link, which I found. But basically what I did there was look at a time in the beginning of his career when he started managing 7 million investor capital. And obviously he's very good at what he does. So he grew that capital to 104 million within a period of 7 full years of investment. More importantly, what we've got here on the right is Warren's net worth. So this is the investor funds he was managing. This is how his own money. And as you can see, in the period of growing investor funds by a factor of give or take 15, he grew his own money by a factor of 25, which was a much larger compound rate. And today I'd like to explain to you why investor leverage can be such a powerful compounder for you. So let's start with a very simple example. Let's say you're a trader who's trading very successfully with a goal of 20% return per year, which by most retail trader standards is a pretty low goal. Monthly, that equates to 1.5% of profit. So let's assume, by the way, I can circulate this Excel sheet for you guys at the end of the webinar. Let's assume you started trading, for the sake of example, 3,000 euros. This, every different people will have different monies, but we got to take some number. And let's say we traded at 20% growth per year for something like 13 years. And this would take us to multiply our capital by something like, well, a factor of 8 or maybe 9. And to most people, this is like low excitement and not good enough, because obviously if you're trading full time and you're only going to multiply your capital by, say, 9 times over the years, probably we need to have more risk. So let's say, we even just went for obviously more risk to get more return. And here you can see the magic of compound interest kicking in. However, this is not spectacular numbers. Obviously, if you have 3,000 euros and you're spending a lot of time trading, you want to make a lot more P&L than 23,000 bucks in 10 years. So let's introduce the concept of healthy leverage. Healthy leverage basically means if you're achieving consistent returns of 20%, you're obviously doing a very good job, because that is a return that very few investors achieve over the long term. So presumably, you could go to some smart person who knows this and tell him, okay, well, I have been growing my capital for the last 3 years at a rate of 20%. I can also grow yours because I'm trading foreign exchange, which is one of the most liquid assets on earth. So I'm told that there's some issues with sound. I'm really sorry about this. It gets better. So basically, let's say we can manage to convince an investor to give us 1 million of his capital for us to manage in exchange for a success fee, whereby for every euro that we make him, we keep 20%, i.e. 20 cents in that euro, which is I'm plotting here. So let's say we continued to exercise our skill of growing capital by 20%. And in that situation, things are becoming a lot more interesting because as we grow investor capital, we get paid the success fees, we reinvest those success fees, and hoopla, all of a sudden, instead of a much smaller amount, we get a substantially higher growth rate of almost 80% per year on our capital, just by virtue of doing exactly the same thing where we were doing before, trading presumably the same assets with 1 million of assets under management. And if you have a stable, scalable enough strategy, this is not a crazy thing to be doing. However, whilst this is already a very healthy amount of leverage, remember you're returning 20% to make for yourself 79%. There's what I call turbo leverage, which is of course the fact that as people hear that you have a gift to grow money by 20% per year on a consistent basis, which is a very, very precious gift because this is very, very hard to obtain, then presumably your investors will be happy enough with you so that they recommend them to other investors. And let's say, in addition to growing whatever capital you had at the beginning of the year by 20%, let's say 1 in 5 of your investors is getting a new investor in, which allows you to grow your assets under management additionally by 20%. And here is when the numbers are really getting spectacular, because you started with 3,000 euros and you could find yourself within a relatively short time span owning 3 million euros. And this is only the start, of course, because the more you compound this, then that's when things really go crazy. If you want to compare the different business model, you can see that the healthy leverage basically destroys the solo at 50%, assuming you could make 50% per year, pretty much almost from the start. So as you start being investable to get those investors in, there's no return that you can obtain on your capital that's really going to beat either healthy leverage, let alone turbo leverage. You can see the different business models. And this is the reason, by the way, why hedge fund managers become billionaires. Not because they grow their own money at a 1,000% rate, because that's really hard, because it involves a lot of risk taking. It is actually because they manage to grow assets with controlled risk consistently over time. And believe me, a 20% rate is more than plenty to get you very, very, very far in your lifestyle. So that is the magic of compounding. And with that magic comes an additional benefit, and that is that as investors leverage your skill to grow money by 20%, you not only make more, but because you're not in a position to take too much leverage, because remember, you're taking little leverage on a lot of funds, the big investor leverage here, you can afford to ride out volatility. So whenever there are spikes in the market that are pretty much designed to catch all these retail traders who are trading with 200 and 300 to 1 leverage, then you can basically watch as they get butchered and even prepare to benefit from it, because you know, because you're taking low leverage, it is not going to catch you and destroy you. So that is perhaps my core message for today, and that is to think of your long-term business model. If you are serious about trading, then just trading your own capital cannot be the right goal, because let's remember, it is a far inferior proposition to anything that you can achieve even by just landing, say, 1 million of investor assets under management, which is really not much if you're making 20% per annum. With that said, we can now talk about toxic leverage if you weren't convinced enough, and I'll give you some reasons why leveraging yourself too highly is bound to end in disaster. There are three reasons in essence for that. The first one is that the higher the leverage you take on your own capital, the more is left to luck. So you do not have perfect foresight as to what the market is doing. You always have to allow for the unexpected, and the less risk you take, the more room you will have to maneuver if the unexpected goes against you, as we'll see in a second. The second is that we are all human. Of course, many of you might be trading algorithms, but also many of us are human. And even if we are trading the algorithms, we control them ourselves. And we are subject to something called loss aversion, which I'll explain in a second. And last but not least, which sounds even like a truism, when you are trading with a lot of risk, and let's assume you're trading the best possible strategy on earth, you have a fantastic win rate and a fantastic win per trade and very low loss per trade. Even then, you have such a superb strategy and you are taking a lot of risk, then every trade could be your last, regarding of how good the strategy is, precisely because you're leaving too much for luck. So let's focus on that in a second, and I'll show you some practical examples to prove just how bad this can get. So to the first point on luck, there are things which are pure skill. Let's think of chess. There's no luck that goes in there because nothing is going to move your opponent's your opponent other than your opponent. There's nothing that goes in there. If you go for tennis, well, you know, there could be wind, there could be, sometimes there are decisive points that go one way or the other and so on. But as you move to the left, you get to a point where the random component is becoming bigger and bigger, and it is harder to predict the outcome of a given bet. So for you, it's for you to decide whether you want to be in the trading world. Of course, you will have to take quite a bit of risk because you cannot make profits if you don't take risk. But there's a thin line between trading and gambling, which is leveraging a punt and praying or enjoying, depending on which way it goes, until it goes the only way that it can go, which is to lose. And knowing, as we discussed, that the higher the risk, the bigger the room for luck. More importantly, there's a concept that few people understand, which is how market-making brokers make their money, and that is called the principle of loss aversion. The reason why it comes about is that we as human beings can be in three states when trading. The first one, when we're taking too little risk, and actually there is such thing as too little risk, we can grow complacent and not pay attention to the market, which is going to result in bad things. At least, you know, we could be wasting our time in front of the screen to achieve nothing, because if you don't take enough risk, you don't make enough return. At the other end, when things get hectic and we're trading with very high risk, then we go through a transition from being asleep to alert to straight away panicky. And when we are panicky, we cease to be rational. And let me highlight an example of how that works in a different setting. Let's say you were placing a bet where you could win 100 euros with 95% probability and win nothing with 5% probability. Further, let's assume that I came to you ahead of that bet and guaranteed you, okay, let me give you 90 euros and you walk away from the bet. Well, presumably you would tell me, hey, you kind of, you know, this is a scam. I know 95% probability of 100 euros has an expected value of 95 euros and you're only offering me 90. So, you know, what the heck, I'll take the chance and hope for the best because very likely I'll make my 100. So you do not take it. In doing so, you would be rational and still stay within this part of your mental spectrum. Let's now think that you were in a settlement case in court and had a 95% chance of winning 10 billion euros and a 5% chance of not winning anything. Yeah, you don't get this aversion. Let me try to explain. So let's remember in the first example, we had a small amount and we were being offered 90 euros for something which was worth 95 and we didn't take it. And now we have an example where we have 10 billion with a 95% probability, which means potentially we can get. Okay, hopefully the sound is back. So we have an example where we're not exposed to extreme risk and we are acting rationally because we are being offered 90 euros for something which is worth 95. And then we're in the same example where it's the same situation, but instead of playing for 100 euros, we are playing for 10 billion euros. And in that situation, I don't know about you guys, but if I was offered 9 billion for sure, yeah, I'm really sorry guys about the sound. I'm doing my best, but it seems to not be working. I'm staying close enough to the microphone, so I'm really sorry. This has not happened before. As we go to something extreme, then we are being offered 9 billion for something which is worth 9.5 billion, and we take it. And why is that? Because the mere thought of foregoing 10 billion makes us act irrationally and go for something which is worth less than what we had in a riskless world. Let's apply this to trading terms, because this is the principle behind what people are known for, cutting winners short and letting losers run. So what I've got here is the maximum favorable and adverse excursions for a trader who's actually a very good trader. When you see the green bar is the maximum equity gain that the trader made for each of these positions, and the red bar is the worst equity loss that the trader made in each of these positions. And you can probably see a small black dot, which is the point at which he closed. Now, if we look closer, you can see that the size of the biggest losses are about 3 and a bit blocks, whereas the biggest gains are less than 2. And we have quite a bit of trades where this maximum threshold of 2.5 is exceeded. So in other words, both sides of the trade are asymmetric, which means in this particular case, the trader is settling on average for bigger losses in some cases than the maximum wins that he can hope for. And this is a very likely indication for loss aversion, which is exactly what happens when you trade with too much leverage. When you're trading with a lot of leverage and you're making money, you're panicking and go, hey, I am making money, let's close this trade so that I don't get to lose, which normally results in closing those winners early. When you're losing money, you're basically almost gone because of the leverage, and then you're really hoping that things go right until they don't, and you're kicked out of your position. And this is one of the reasons why leverage is toxic, because it triggers particularly non-experts to be loss averse. It is actually the #1 newbie killer. And last but not least, there's something which is very, very obvious, but has dramatic consequences. When you're trading with very little risk, as you are doing here on the left-hand side, you are as good as your average trade. You can afford to have losers because you know on average they will be more than compensated by your winners. When you're trading with very high risk, you're betting everything, you're betting all your existing capital to make more on what you have. And that has the benefit that you can make a lot if it goes well, but it has a big drawdown, which is that you can lose everything if your last trade went wrong. If you don't believe me, let me just go. My view on Euro pullback. Okay, I don't like to give views on currencies for a number of reasons, but let me put it this way: if I told you my view, I would. Let's take that at the end. It's an interesting question on the Euro pullback. Let's take it at the end. But basically, what I was saying here is that on every trade, if you take a trade with very high risk, you're going to lose everything. And I'm going to show you something which few people show you, and this is what I call the boulevard of broken dreams. You may or may not know that Darwin which is the company that I'm the CEO of, runs a competition by traders, which is 100% free for everyone to join. And there we rank people by the return they are making and also compare them across risks. So I have now gone into our leaderboard and I am showing you both the returns by the guys who are making the most. So you can see some amazing returns for the very high risk here, which is what people typically advertise. But then we have 16, so 160 strategies in here, and I'm going to show you what happens when you take a lot of risk. This is what happens when you take a lot of risk. You take a lot of risk and you lose everything. Sooner or later, you go up like a rocket and then eventually you lose everything. I can go down the leaderboard, still the same. Why is that? As I just said, if you're gambling everything on your last trade, then it could be your last trade. If it goes well, you're going to make 1,000%. If it goes badly, you will lose everything and you will have to start over. And if you think back of what Warren does, then you can see that this would be pretty much the end of his career, because who trust someone who loses all that money? What's worse is I'm going to show you a strategy by someone who unfortunately has had that, who is actually a very good trader. So let me show you the other one. Apologies, this is not it. This is the one. You can see the returns here. They were outright spectacular for quite some time. And then a bad series hit in a relatively short period of time. And this is not because he had bad risk management. This is simply because he had very, very high risk. The important insight about this one is that you could take exactly the same strategy and enter exactly the same trades at the same time, but instead of the leverage that he was taking, a much, much lower leverage. And here's what, you will still continue making money, because when you take low risk, as we were saying, you're as good as your average trade. And when you hit that rough patch, you lose something, but you don't lose everything. When you trade with very high risk, you're as good as your last trade. And even if the strategy would have made money to someone who's good on average, you will lose everything. Okay, so that's basically why leverage is toxic. So if we combine both, what do you need to do to get to that position of making that, that 20% or more per year? I'm going to show you someone who doesn't risk more than 20% per month, which is high but not crazy, and is making a 400% return with stunning, fantastic risk management. So it doesn't take so much risk for you to get there. Sorry guys, my phone is ringing. So the risk need not be that high. And what this person is doing is he's really controlling the market by managing what he trades, when he trades it, how often he trades it, and how long he keeps his trades open. And here's what the risk management principle comes in. He's trading with a leverage method that suits his needs, which basically means you open the trades always with the same leverage, whatever that might be, but do not change leverage across trades for a number of reasons that I'll discuss in a second. And then all you do is set your own stop loss and you take profit and hang on to your trades. Perhaps you might even want to close them, even if they haven't reached their stop loss, or take profit at that end. Okay? So that framework is basically to say, I will make a promise to myself that I will not lose more than an X% of my equity, which could be 10% or 20%, whatever. It's really your choice, more often than a given period of time. It could be, say, 20 months. And once you have made that decision, you trade all your trades with the same leverage that is consistent with that strategy risk. And as you have your trades going, you basically just watch that you're staying within that risk framework. So you fix a global strategy level target and implement it for every trade, no matter what. So you're probably asking yourself, how much risk do I have? Well, here we're offering a free tool, no compromises, available to anyone on MT4, which if you upload your existing strategy, is going to tell you how much you are risking on your worst month every 20. So for instance, in the case of this trader, it is 7% of his balance. If you want to figure out for yourself, you can find it in this website, which, by the way, as I said, is free and 100% available to anyone on MT4. Once you know that, you pick your risk, your target. So you say, well, 7% is okay for me, or 10%, or 20%. What you'll find most likely is that you're taking way much more risk than you knew. So most likely the tool will tell you you are likely to lose, say, even more than 50% of your balance in the worst month every 20. Once you have that, I have told you before that you always have to take the same risk across all your trades, and this is the reason why. So if you knew exactly what your next trade was going to be, then you would be in a position to pick the local minimum at which you would go in, the local maximum at which you could go out, and since you know exactly, you basically have no uncertainty, can leverage yourself to the infinite and make amazing profits. Now, obviously, this is not the case. No one is going to have full certainty, and you will not want to lose everything if your bet goes wrong. Therefore, there is no justification for changing your leverage across trades. So the best you can do, given that you don't know what's going to happen, is to always take your trades with the same leverage. Here's where some people would say, hey, maybe I would like to do high conviction trades with higher leverage and lower conviction trades with lower leverage. Well, there are two schools of thought here. The first one, which is the one that I adhere to, is that I only take high conviction trades. If they're low conviction, don't take them. So, and of course, that affords you the possibility of taking twice the risk in those cases because you'll take less trades. But that's basically the idea. There's no point in changing the leverage across trades because that's, A, you don't have a justification for it. And second, what it could do is that somehow your strategy is losing money. And this could be not because the strategy is wrong, but because you've happened to be unlucky with a few trades where you took too much leverage, and that's why you seem to be losing money, even if your strategy is good. So that's the framework. It's basically you have a target, you figure out what your leverage is that you should take every trade, and you just watch those trades as they accumulate are building up to being the overall risk target that you were going for. Again, we have a tool here. If you want to know what your target should be, you can upload your strategy, and this blue line, when you go into the particular chart, will tell you exactly roughly what that leverage should be. For instance, in the case of this particular trader, it's somewhere like about 5 times as risky the euro-dollar. So if he was trading euro-dollar, he should always place trades with 5 to 1 to meet his own personal target. And that's pretty much it. So to summarize what we've talked about today, you should hopefully have believed me when I say that it is much more powerful to make 20% year in, year out than it is to gamble everything and risk losing both your money and your credibility with investors, which will force you to start from scratch. And then if you have believed in that, all you need to achieve is no more than 20%, assuming that you're taking a low enough risk, which, by the way, is warranted, because if you take in high risk and make 20%, it will be very hard for you to sustain that 20% over time. So that's the idea. Trade always with the same risk, stick to your strategy, polish it as you go along, find the assets that suit you the best, find the frequency of trading and the length of trading that you feel most comfortable with. And once you have that, all you need to do is place all your trades and positions with the same leverage. And eventually, once you can prove a consistent enough track record, you can go to investors who will give you the kind of healthy leverage that allows you to watch the market as everyone else is getting crushed, and you just, do what you have to do to get to your 20%. That was pretty much it for today. So I've now left aside 10 minutes if you have questions or feedback on stuff that we have discussed. So a very good question from Jason. What are the benefits of time limits on a trade? Okay, so there are several schools of thought here. I'm not saying you should have time limits, but basically when you go into a trade, it is because you have identified some setup that you expect to unravel over a given time period. And in that situation, you should be honest with yourself in assessing whether actually what you thought would happen actually did happen. And in those situations, the best thing to do is to open a trade with a time duration and a stop loss and a take profit, and just wait it out, because that's the way that you can learn whether the setups that you plan actually play out in practice. So it is going to help you assess whether your strategy really is sound. Of course, if you don't do that, it could be that the trades go for you or they go against you, but you're actually introducing an element of random variation, which was not really part of your strategy. So you could have a risk of fooling yourself by thinking that your setups were playing out, whereas all that was happening was really that you were being lucky for a while. Hopefully. But again, there are schools of thought around this one. If you have the stop loss and the take profit, then probably that's going to take you a long way in getting where you want. Okay, so there was do we have competitions at Darwinix? Yes, very much so. What I showed you was the competition that we run, and we will shortly start paying out monies for people who achieve the highest scores on our assessment. Then there was this very good point by MRC on whether I could give my view on the euro pullback. Let me tell you why I don't give my views. So let's say I was a very good trader, which I'm not, by the way, but let's say I was a very good trader. If I were to share my views with you, then what do you think, what incentive would I have to share those views with anyone who was watching me without charging you for it? So if I don't get anything for it, why would I share any valuable intellectual property knowing that you could free ride on it? I would gladly tell you my view on the euro pullback, but unfortunately I'm not a very good trader, so it would probably not be very much use to you. And what I'm trying to say with this one is that beware of people who go around giving you advice, because in many cases it's going to be people paid, say, by brokers or others who have their own agenda to get you to do stuff which is in their interest and not yours. And unfortunately, the Forex industry is full of people who don't know shit about trading, and they go around talking like they did. And what happens is what I showed you before in the Boulevard of Broken Dreams, is a lot of people who lose their money and their hopes because of trusting people who should not be trusted. Okay, I don't know if you have any other questions beyond that. Yeah, I'm not saying the problem is, of course, is that there's nothing free in life. So beware of anyone who gives you something valuable for free, because maybe either it's not valuable or it's not free and they're getting something else from you and you don't know about it. This is recording as far as I know, so hopefully the sound quality was not too bad. And where can you heed these advices? Well, again, this is trading is a bit like an exam, where in theory you should be working for yourself to beat the market, because no one, given that they are all competing to get a good grade, is going to give you this advice in an uninterested way. So bad as it sounds, the best way to learn is to try and hear a lot of people, knowing that everyone might have different agendas, and trust your own instinct without trusting others too much when it comes to things like making profits through euro pullbacks. Trading is part art and part science. The part of art cannot be learned and cannot be taught. It's only by having the science part, which is basically the risk management, in place, that you will have a lot of time in the market. And the more time you spend in the market, the better you'll be in a much better position to figure out what's going on, because you will be basically the eldest and wisest person looking at something, and you will be surrounded by kids. So you know what's going to happen before everyone else does. That's basically the idea. So develop your own sound risk management. This will buy you time in the market, and once you spend time in the market, if you have a talent, your art will come forward and you will start making money. But that's the way it works. I don't think there's anyone who can give you advice on how to make money quickly, because most likely, if you're getting some advice on making money quickly, it's coming by someone paid by a broker who's incentivizing you to take trades with too much leverage and lose everything, because they actually win from that. I'm sorry that I can give you better news, but trust yourself, try to learn, and don't pay too much attention to advice, is my best advice. Okay, I think we're almost over with time. If you have any further questions, I'm going to write my Skype user number here. So if you want to reach out privately for something, oh, sorry, I wrote it. Here it is. If you want to reach out privately for anything which we haven't covered today or was not the topic of today's agenda, I'll be very pleased to take that call. You can also contact me at my email address, which is this. So that's it from my part. Thank you so much for attending, and I hope that this was useful to you going forward. Take care and happy trading. Thank you all. It's great to share insights with you guys. Take care.